Without further ado, I'd like to announce your speaker for tonight, my wife, Debbie. Debbie's a graduate of NYU with dual degrees. She's also a certified financial planner, and she's also our lead portfolio manager.
Thank you, everyone. Thanks. That's going to be a tough act to follow. And so welcome, everyone, and thanks to my staff. As usual, not only from the planning, but the execution, everything just goes flawlessly when we get here tonight. So thank you all for being here. As Stephanie said, it's so wonderful to see a lot of new faces, a lot of very familiar faces of people that not only have been for the 5 years that we're doing this, but for years when they remember me when I was pregnant for that young lady that just got married. So many of you have been around a long time, and also welcome to the prospective clients who are here tonight. I hope you're having a wonderful evening. Hope you're all enjoying your summer, and we have a great presentation for you tonight. And you know, when we plan these things, it's based on the calendar. We do January and we do July. So we never know what's going to be going on in the markets when we plan our dates. And there couldn't be a better time to be here to talk to you tonight. There's a lot going on, and hopefully I'll be able to make a little sense of it tonight as we go through the presentation. And I got a lot of information to cover, so I promise to help to walk you through an awful lot of it. But I'm not going to sing or dance, and although we're in a theater, but I do promise to try and entertain you tonight as well. So hopefully we'll have a good time with this. So let's get started on our information. As usual, we're going to cover, for those of you who are new to the presentation, we're going to talk about where we've been, where we are, and some of the things that we're thinking about as to where we're going. But we're going to start the night, as usual, with a little bit of trivia so that we can get your brains going tonight and get you started, take you away from cocktail hour for a little bit and get the brain started. Our theme for tonight is going to be changes in 2015. We'll start with the first one. Who delivered their last monologue as co-host of the Golden Globes? Was it Amy Fowler and Tina Fey? James Franco and Anne Hathaway? Kristen Chenoweth and Alan Cummings? Or Jon Stewart and Stephen Corbett? Number one. And we're certainly going to miss these jokes. Tonight we celebrate all the great television shows we know and love, as well as the movies that North Korea was okay with. And the biggest story in Hollywood this year was when North Korea threatened an attack and Sony released The Interview, forcing us all to pretend that we wanted to see it. Which popular television series is signing off after a final season? Parks and Recreation? Mad Men? Late Night with David Letterman? All of our TV fans? All of the above. What changes did the NCAA approve in men's basketball? Probably a lot of you don't even care. 60-second shot clock, more timeouts, the arc underneath the basket will extend, or none of the above. For those of you who care, the arc underneath the basket will extend an additional 4 feet. Yay, right? Terrific. So, any other Patriots fan in the house besides me tonight? Yeah, okay, so we kicked off the year, no pun intended, with the Super Bowl, and I am a Patriots fan, so happy that my guys win. But now we'll start the season with a couple of games with Tom Brady on the bench this year. So let's talk about the market. So let's start talking about the market performance. This graph that I have up here tonight, my first graph, is probably one of my favorite graphs of the evening because it's very telling about a lot of things that are going on out there right now. And if you look at this graph, the first bar chart in each section, or the first bar of the graph in each section, is representative of the return of that particular sector or index for all of 2014. The one next to it is the return for that particular sector so far year to date 2015. What you can see there is that although last year we had a great year in the S&P 500, it's moved literally nowhere this year so far. Last year we talked about the fact that the foreign markets had been underperforming and underperformed the US markets last year as well. This year, the foreign markets are outperforming US markets. Commodities and gold, all on the downside, were and continue to get beaten up in this market this year as well. But it's that far right chart that I think is so telling of a number of things. That's the REIT index. And that would be representative of other types of stocks in the market that pay high dividends, like the telecom sector or the utility sector. This was last year the best performing sector and threefold outperformed the S&P 500. And this year is down quite substantially. Certain parts of this sector have been beaten up terribly. And I think this graph speaks to the pros and cons of diversification, right? Because when you look at last year, wouldn't it be nice, and investors have what I call a propensity to want to load up on what's working well at a given time. And had you loaded up your portfolio last year looking at what was going on in those high dividend payers, you're having your head handed to you this year. So although at different times within the portfolio there's certain sectors that are not performing well, it is really difficult to try to follow one particular sector of the market or one index or one particular industry because of the volatility within a given time period of what's working and what's not. There was a study that I read this year, and it really speaks to the way we manage money. And somebody had done a comparison of the NASDAQ over the last 15 years versus what they called a composite portfolio. And interestingly, their composite was stocks, bonds, and gold. And only 7 years out of the 15 did the composite actually beat the NASDAQ. But in the long term, the composite portfolio outperformed the NASDAQ over 2 to 1. So we have periods of time, and there's shortened periods of time, and sometimes it's months, and it may be 6 months or 12 months or 18 months, that you got things in your portfolio that are not working. It doesn't always mean that you own the wrong thing. It means sometimes you have to wait for those things to come your way, because if you follow all the things that are working, you're likely going to end up at the bottom of the heap the next time around. So let's take a look at what our market actually has done this year. This graph tells us an awful lot as well. The S&P 500 as of June 30th was up 0.2%. The Dow Jones Industrial Average down 1.1, and the NASDAQ up 5%. You see that middle line? That's the Dow Jones Industrial Average. Here's the frustration in this market. As of earlier last week, we had already had 61 days this year that the Dow closed either plus or minus more than 100 points. So to get to a zero performance so far, just on those 61 days, we traveled almost 12,000 points to make no progress. In all of 2014, the market only had 85 days where we had plus or minus 100-point closes. So this year has been exceptionally volatile. pushing things up and down and yet not making any progress. That becomes a frustrating market. What is the economy telling us? We talked last year about the fact that we started out the first quarter of 2014 negative. By the back end of the year, we ended up with positive growth. But the trend here doesn't look so good, right? Q2, Q3, and negative GDP once again in the beginning of 2015. So the trend in the growth certainly leads you to believe that people are becoming a little bit worrisome, that all the work that's been done and the stimulus that's been provided, it's not taking hold, and there's a lot of concern over whether it's going to work or not. So what's causing the slowdown in growth? We can attribute a number of things to the slowdown in growth. Lower oil prices. Now, isn't that backwards? Lower oil prices is supposed to stimulate our economy, right? Not so right now. We've had a collapse in the commodities market during a period of time where we are now the largest oil producer in the world. The oil companies are shutting down production and they're laying off thousands of workers every day. Oil continues to struggle here, and it's all the ancillary businesses that go around them. We'll talk about why maybe the lower oil prices are not a stimulus to the economy. Our US dollar is gaining strength. Isn't it good to have a currency that's real strong? That's what you hope for, a good, strong greenback. Well, guess what? When our dollar strengthens, it makes our businesses less competitive around the world. Our products are getting more expensive to foreigners every single day, which is probably what's leading to the decline in exports. Exports are down 3% last quarter on a year-over-year basis, and if our dollar continues to strengthen, we can expect that our exports will probably continue to struggle. We're right now in the heart of earnings season, and just about every company that we listen to, they talk about the currency conversion and the negative impact on earnings that they're seeing in their overall performance. So that's going to continue to plague us. Slower consumer spending. The consumers just not come out from what happened 7 years ago. We're waiting for them to come out and spend this extra $15 for every time they fill up their car. They're putting that money in the bank. They're paying down debt. They are not rushing out to spend this money anytime soon. And maybe we can attribute it to the slow wage growth that's going on out there. Let me give you a number that I think is actually absolutely bone-chilling in how tough it is for the average consumer out there today. Real household income today is $2,000 a year below where it was on an inflation-adjusted basis from the time that Barack Obama entered the White House. It is $3,600 a year below where it was 8 years before that when George Bush entered the White House. So we have virtually seen household income decline over the last 15 or 16 years. It is very hard to get GDP going in the right direction. See, you and I, we're the consumer, we're 70% of GDP. If we don't have spending power, GDP is not going to be able to grow the way we want it to. Yeah, we need our exports and we need all that. But if you and I don't have the wherewithal to go out and start spending money, it's going to be very, very difficult for this economy to actually begin to heat up. So lots of reasons we can talk about slower growth. So what's happening in some of the other markets around the world? Well, guess what? We open up the papers every day to hear about Greece and all the problems that are over there, and guess what? Europe is growing. Europe is beating us right now. Europe's economy grew 0.4% in the first quarter. Some of their economies are actually showing pretty good growth. Well, you want to know why? ECB. The ECB has taken a page out of the playbook of our Federal Reserve, and now they are providing monetary stimulus to their economy, and in a number of very aggressive ways that we have done here already. So guess what? European economies are beginning to grow. The euro has lost value, opposite of what we have here, right? Their products are getting a lot more competitive to buyers all around the world, and so the opposite effect, their exports are increasing. So by the actions of their Federal Reserve, they are now in a position that they are becoming a more competitive economy against the United States. And you know what? They don't have a lot of oil production. They're not losing jobs to lower oil prices. Their consumers are benefiting every day by the fact that they're paying less for their energy costs. They're not losing the number of jobs that we are. So Europe is actually starting to take hold. Well, not all central bank actions are predictable, or do they get what they expected. Early this year, we opened up to the news that the Swiss National Bank decided they would depeg their currency. We believe that they wanted to front-run the ECB. They knew that the ECB was going to stimulate the economy. They didn't want the euro to get in front of them, so they would depeg their currency so that they would devalue it so that they would get in first place. And guess what? Their currency appreciated by 30% overnight. A 2 or 3% move in the currency market is a lot. A 30% move is absolutely devastating. So what'd they get? World stock market sold off. The Swiss market dropped by 10%. Many of the currency traders became insolvent within hours. And loans that were tied to the Swiss franc in high risk of default. See, so the lesson here to me is when you have central bankers meddling in the system every day, every month, for the last several years, some of the results we can predict and we get what we want. You don't always get what you want. And these are the things that how do you go back and repair the damage? The euro, or the European area, was full of some more surprises. So we did quantitative easing in this country in order to push interest rates lower. I know we talked about that last time. Lower interest rates is meant to stimulate growth, stimulate spending. People will borrow to spend. Well, when Europe embarked on quantitative easing, their interest rates were already very low. And guess what? They went negative. So in all of these major economies, we actually had a negative interest rate environment, which was throwing off all the markets around the world because they should trade in some tandem. The German Bund, which is their 10-year equivalent of the US 10-year Treasury, traded as low as 0.05%. That had a major impact on US rates earlier this year. We'll talk about that in a second. But this became every borrower's dream. So imagine this. Here's Miss Christensen, a 36-year-old entrepreneur. She had been approved for a small business loan. Her interest rate minus 0.0172. So there would be fees to pay, but she'd be earning interest a little over $1, but still. So the New York Times writes this: these are strange times for European borrowers, as if a wormhole has opened up to a parallel universe where the usual rules of financial gravity are suspended. How do you put that together? What does that mean? What will happen if we continue to be able to pay borrowers to take money out of the bank? And guess what? Hey, the average Joes like you and I that have our money in the bank, they started receiving letters from their bank saying, we're going to charge you to hold your money now. Backwards environment, right? Well, the Europeans got partly what they wanted. Their stock markets went up. So just like here in the United States, our Federal Reserve did quantitative easing and our markets went up. Europeans, well, we'll do it too. We'll stimulate. Markets went up. The CAC and the DAX up 11% and 12% respectively. Remember I talked about in the beginning the foreign markets doing better. The FTSE was about flat, but they provided stimulus and the stock market went up. Bank of Japan says, hey, we're not going to be left out of this. Bank of Japan is largely credited with being the inventor of quantitative easing at the turn of this century. They're still at it. They decided, hey, if we do a little bit more, we can get the inflation rate up. Well, lo and behold, oil prices plummeted. They didn't get any inflation. The yen remained relatively stable. No growth. Japanese economy is still not growing. But guess what did go up? Their stock markets. So here, once again, enter the central bankers, and the markets are loving the way this works. So the Hang Seng went up about 11%, the Nikkei went up 15%, India was relatively flat, but they had a phenomenal year last year. And oh, guess what? China, after dropping precipitously very recently, they're still up about 30%. So like we were talking about earlier, maybe it would be a good idea to have a lot more money in the Chinese stock markets, right? Let's take a look at this. At least 80 Chinese firms changed their name in the first 5 months of the year. A hotel group rebranded itself as a high-speed rail company, a fireworks maker as a peer-to-peer lender, a ceramic specialist as a clean energy group. Their reinventions as high-tech companies appear to have less to do with the gradual rebalancing of China's economy than with the mania sweeping the stock market. The final line here, the Chinese stocks have long had a tenuous relationship with economic reality, but the current rally has gone to new extremes. And take a look what happened. Even after a decline of 36%, their market is still up almost 40% year to date. From May of 2014 through May of 2015, they opened up 40 million new brokerage accounts. At the height of the frenzy, they were opening up over 3 million accounts a day, and many of these people were getting in on margin, which means they were borrowing in addition to what they were putting into the market, considered very highly speculative. And so when the bubble started to burst, it got nasty real quick. So the Chinese government, see, they're different than us, they stepped in, they put restrictions on margin borrowing, and they said, anybody who's an institutional investor, you're not allowed to sell your shares. So they've stopped the bleed so far, but what's really going on in China? Is there any substance underneath those stock prices, and what can we expect from here? The problem that it causes in understanding what's going on in the markets, this is a $14 trillion market. That means there was a lot of net worth wiped out in just the last several weeks. What impact will that have on their economy going forward? If China's having a hard time growing now, what will be the impact if their stock market continues to take back the gains of a lot of their wealthy individuals? So let's talk about here again. Volatile government bonds. This bond market that we've witnessed this year in the first 6 months is unlike one we have ever witnessed before. Let me put some math behind this. From February until March, 10-year Treasury rates rose by 33%. From March until April, they declined by 17%. From April through mid-June, they were back up 34%. The problem here, all rates key off of US Treasury rates. Your municipal market, your mortgage market, your muni market. So with rates bouncing around like this, it makes it very, very difficult to peg what is the cost of borrowing. Long-term rates this year have moved up. We started the year around 217, we're today around 235. That's not a big move. Reminiscent of that Dow chart that I showed you earlier, lots and lots of up and down, not a lot of real progress in one direction or the other, causes a lot of confusion. Government bonds have been typically the source of safety and stability in most people's portfolio. And if you're not getting there, it makes everything else even more unsettling. So many people are asking, why all the instability in the government bond markets? They cite trading algorithms. This is another fancy name for the high-frequency traders. They don't just play in the stock market, they'll play anywhere they can. This means massive, massive amounts of capital moving in and out of the market in typically the same securities, very quickly making moves much more extreme than they used to be in the past. Many people also say that it has to do with the fact that the banks are no longer as involved in the government bond market or any of the bond markets post the financial crisis. We have all these new regulations, and one of them restrict the bank's ability to be a market maker in the bond market. So if you have bonds to sell, there are less people out there willing to make a market for those bonds. I say quite simply that the volatility has to do with the confusion about monetary policy around the world. When you have European interest rates going negative, US interest rates dropping close to 1% on the 10-year earlier this year and bouncing all over the place, nobody knows where real rates should be when central bankers have been manipulating the markets for several years now. So I equate it very simply as like musical chairs. And the music is still playing, but everybody's getting a little bit more nervous about what's going to happen when the music stops. And they want to still have a seat at the table. So that, to me, you can talk about fast money trading, and you can talk about who's in the market and who's not. I'll tell you, it's raw confusion. And it is very, very difficult to understand what capital should cost in an environment where we've been manipulating the interest rates for years now. So where are we with all this? Now that I've thoroughly confused you, right? Our economies are growing. And I think this chart, too, is very telling about some of the things that are going on out there. The first bar in each country there is representative of GDP. So you want good, strong GDP. The second bar is inflation. You want moderate inflation. And the third bar is unemployment. So you want low unemployment. There's only one economy that looks real healthy there, and it's India. And people are talking an awful lot about what's going on in India. This is a massive, massive economy. But this bar chart can also tell you what are the problematic areas within each one of these different areas. So look to your far right, to Europe. You're not getting very far when you still have double-digit unemployment. And I've talked to a lot of clients recently who have traveled in different parts of Europe, and they talk to the people there. And it's awful. It's awful. When you still have 50 Greece, 25% unemployment. They're never going to pay that money back. So you've got all different parts. When you take a look at Brazil and Russia, negative GDP, we can explain that pretty easy. These are commodities-based economies. They're not going to be growing anytime soon with commodities prices continuing to collapse. When we look at Japan, I mentioned they've been stimulating now for 15 years, if not longer. They've still got no inflation. They've still got no growth. They've got low unemployment. That's because they have no workers. So with all that work, now China, good growth, but they need more inflation, and they need a lot more growth than they have. And of course, we know the story in the United States. Mediocre growth, no inflation, moderately low unemployment. So it really starts to show you all around the world, although we are growing, each continent in each different area has a lot of their own particular problems. I almost made it this far, and I did mention Greece once, but here it is again. So we do need to talk about Greece. And when we finished the first half, there was no deal, there was no bailout, the banks were closed, the markets were closed. The Greek people had voted against the reform there, and there was complete and utter chaos in the fear that Greece was going to walk away, they were going to leave the Eurozone, and we're going to have a major meltdown in Europe. Well, phew, we avoided that one again. Right now they got another bailout, so life is good. The market rallied 2% on all the fears of Greece are gone. I'll tell you one thing for sure. Greece is not in our rearview mirror. They will be back. They have not done anything to fix the real structural problems there. And what do we keep doing with an economy that's burdened with too much debt? We keep lending them more money. So this is a problem that for now has again made it, down the totem pole as far as severity in the news today. But this is a problem that's going to be with us. Greece is significant. See, the euro, if any of you happened to read my market commentary last month, I spoke about this, that the euro has been trading as a currency, 12 or 15 years now, and took all these different economies and put them together under one currency. And if Greece is to step away, the experiment starts to go bad. And if all these other economies decide we'd rather go back to our way of doing things, it was much better when we were on our own, and hey, we're not going to continue to work for the next 35 years to pay off all that debt from the Greeks. If that starts to unfoil, that will become a major issue. So for now, it's kind of receded into the back pages of the newspaper, but it will come back again. So we need to watch what's going on over there. Waiting for a rate hike. So with European interest rates turning negative, complete turmoil in the European zone, our Federal Reserve is sitting there and trying to figure out when she can begin to raise interest rates. So with all of the things, we've got global growth slowing, US GDP heading in the wrong direction, not the right direction. So we're wondering when the Federal Reserve will finally be able to raise interest rates, and it's all about expectations. So she drew a line in the sand, and the Fed told us, when the unemployment rate drops below 6.5 and inflation gets to 2, we're going to start raising interest rates. Well, now recently there's been all of these others. Well, if Greece becomes a problem, that would change our outlook, so maybe we'll wait. So 2 weeks ago, the market was completely convinced that no rate hikes are going to come here, at least until 2016, that 2015 was off the table. We got a deal. Fed told us last week, we got unemployment where I want it, everything's starting to look a lot more normal than it did, and we're going to start raising interest rates. September's back on the table, and maybe another hike in December. So the markets are trying to anticipate, what will this mean? When will it come? And to me, this is the reason for those moves in the bond market, because everybody's trying to figure out when it's going to come and what will it mean. When you raise interest rates, if you're at 3% and you raise a quarter, it's not that big of a deal. But when you're at 0 and you go to a quarter, but think about the next move. A quarter to 50, it's a 100% rise in interest rates. So there's some fear that, this time is going to be a little bit more difficult. So when we sit and wait, what's going to happen with the Federal Reserve, it is becoming an issue to the markets. Minding the wealth gap. So as if the Fed doesn't have enough to worry about, we've got a strong dollar, we've got slowing global growth, and guess what? Here in the United States, the gap in wealth is the worst that it has been in 30 years. Look at these numbers. Of the 20 developed nations, The wealthiest 10% have 50% of all the wealth. The next 50% have 47% of the wealth. And those of you who are quick with math, it only leaves 3% for the bottom 40% of the population. This again, like I talked about with wages, they went back and they did a study from 1963 through 2013. The lowest 10% who had no wealth now are $2,000 in debt. The middle have been able to double their wealth over that period of time. The top 10% have quadrupled their wealth, and the top 1% have seen their wealth grow sixfold. So now why is this a problem at the Federal Reserve? The monetary policy that our Federal Reserve has in force right now does absolutely no good to lower income people and people of no wealth. They don't have money in the stock market. I showed you how the quantitative easing made the stock market go up. They don't have money in the stock market. They're not out refinancing their mortgages for 3%. They're not going and buying the second vacation house. So these 0% interest rates hurt those people. It doesn't help them. So if we're trying to get, again, if we're trying to get this economy on track, the policies that we have in force today need to go the other direction to help out the vast majority of the population, not the higher incomes and higher wealth in the country. Lower income people also have been hurt worse as well. In 1944, the 1% of the population earned 11% of all of the income in the country. In 2012, the top 1% earn 23% of all of the income in the country. And this quote, and if you might not be able to see it because of the green on black, that's not good. Income inequality has a sizable and statistically negative impact on growth. Remember in that first slide or somewhere in the beginning that we talked about there's no growth because consumers aren't spending? How can they possibly be spending? You got all these negative things that are impacting them right now. So one way that many people are thinking that we can go about fixing this is to raise the minimum wage. And there was just talk again today, and I forget which company it was, that they're raising the minimum wage to their workers. Yeah, it was a fast food company, and I can't remember which one it was. McDonald's, thank you. I thought so. And so the city of Los Angeles, they're going to raise their minimum wage between now and 2020 from $9 to $15. So many ask, does it really need to go up that much? That's a 60% increase in minimum wage. Well, if you look at the statistics here, a family, a household of 1 adult and 2 children, $9 an hour is poverty. They need $29 an hour to live in a reasonable fashion. So even at $15 an hour, they are still not living comfortably. Minimum wage, it's going to be talked a lot about. We're getting ready to heat up into political season here. I don't know if it's the right fix or what the right place is, but I'll say this. Minimum wage, or the wages in this country, are just a symptom of the problem. And you can't just fix this by raising the minimum wage. The problem in the country, to me, is the fact that minimum wage jobs were never intended to be careers that you raise a household on. These were supposed to be entry-level jobs for which you started there and then you had the ability to progress upward, right? Well, that's what doesn't exist in this country anymore. There is no upward mobility. You don't have the ability to raise within. And a lot of that has to do with education and training, because that costs money. And nobody wants to spend the money to do that right now. So this is just a symptom of a bigger problem. Hopefully, companies will begin to start thinking about how they can raise from within and train the employees that they've got. Appreciating lower oil prices. So we've talked a lot about the negatives of loss of jobs. Lower oil prices, and again, if they're here to stay for at least a reasonable period of time, and everybody's skeptical about where oil prices will really be 6 months or a year from now, but lower oil prices helps everyone. Now, whether we see it show up in the economy in any big way or not, lower oil prices helps companies, it helps small businesses, and it helps everyone sitting here in this room today. And it's one of the things that it will help the low income more, because a greater percentage of their discretionary income is spent on energy costs. So this could help to begin to fuel a little bit of power in the pockets of the consumers out there. But we talked about the Chinese stock market. What else do we need to pay attention to what's going on in China today? And this quote, and Jimmy Rogers has been around forever. He's a portfolio manager, managed a big hedge fund. He says, well, the 20th century was the century of the US. The 19th century was the century of the UK. And the 21st century will be the century of Asia. And more so as of what's happening in China. And China is taking very aggressive steps to position themselves in a very powerful position in a number of ways. And one of the things that they did earlier this year is they launched the Asia Infrastructure Investment Bank, the AAIB. Now, what's interesting about this is that these are all the partners in their bank, 57 partners representing almost a quarter of all the nations in the world that are part of this bank. And of the 20 developed economies, 16 are also partners. The 4 who are not, US, Mexico, Canada, and Japan. The Asians have decided, the Chinese, that they will not wait for what's going on in our US government or what's happening in Japan, that they will form their own infrastructure for which then they have the ability to finance their growth. They say, we don't understand their needs for capital. Capital is power, right? So if you have access to capital, it makes you more powerful over time. So we got to watch not just what's going on in their marketplace, but a lot of the things that the Chinese are doing in order to build their own infrastructure and become very, very independent in what they choose to do going forward. So, since we're in a theater, and don't get up because you can't have an intermission, you can't actually leave. I did promise, I've been talking about a lot of heavy stuff here for the last 20 minutes. I did promise to entertain you. So I thought we'd take a quick break and a little bit away from the finance and entertain you for just a few minutes. There is a video that's been floating around since 2013. And everybody talked about the thousands and thousands and thousands of hours that people have spent watching this video. So Andrew and myself, he's up there somewhere, he's probably hiding right now, decided that we'd take a little bit of creative and artistic liberties and create a little video for you guys tonight. So.
Get up. 오빤 강남스타일 낮에는 따사로운 인간적인 여자 커피 한 잔에 여유를 아는 품격 있는 여자 밤이 오면 심장이 뜨거워지는 여자 그런 반전 있는 여자 아름다워 사랑스러워 그래 너 hey. 그래 바로 너 hey. 아름다워 사랑스러워 그래 너 hey. 그래 바로 너 hey. 지금부터 갈 때까지 가볼까 오빤 강남스타일 강남스타일 오빤 강남스타일 강남스타일 오빤 강남스타일 에이 섹시 레이디 오빤 강남스타일 에이 섹시 레이디
Mike showed the Tame pictures from the wedding. He looked just like that on the dance floor. So, where are we headed to? Are we going to have interest rate tantrums as the Fed starts to raise interest rates? What havoc will that wreak in the markets? Are we going to have economic growth, or are we going to head down and have a recession? Are we going to continue with this bull market, or are we on the verge of heading into a bear market? So let's see what the experts have to say. Larry Summers, the ex-US Treasury Secretary, he says things are not so good, that all of the actions by the central bankers around the world, that we're going to be caught in a period of time of what he calls secular stagnation. Secular stagnation would be characterized by low or no growth, weak inflation, low interest rates, a period of time when savings exceeds investments. We talk about companies that have all that cash and they're paying back dividends and buying shares. They're not building new factories or hiring people. That's what that would look like. And the European consumers have already spent that windfall, and that the growth that we're seeing out of Europe is somewhat misleading and unsustainable if we see oil prices go back up. So he says, I hope I'm wrong, but I think we're locked in this period because of what's happened from all central bankers around the world. Our prior Federal Reserve chairman, he disagrees. He thinks that on the bottom there, he disagrees, blaming a combination of cyclical and special factors. Well, my question is this. Either he hasn't figured out what those factors are, or they just don't know how to fix them because we're 7 years in this and we still have not seen the light of day yet. According to the IMF, here's some good news. The IMF says 2015 will be the first year that all advanced economies grow. And it will be the first year since 2010 that the largest advanced economies will grow by a rate of greater than 2%. And if that can actually happen, that's going to get us out of the quagmire that we've been in. Their concern, however, is that as each economy, the US is already beginning to do it, we're pulling back some of that stimulus, we're seeing growth tail off. When the Europeans have to stop stimulating, they'll see that growth tail off. So that although things are heading in the right direction, that we will see slower growth going forward. So what about our markets? Because remember, there's the economy and then there's the markets. And I know we talked a long time about the last few years where we had this lousy economy and a great stock market. And I know I've made the comment before that the irony will be that when the economy starts to get better, the stock market will begin to have trouble. That's right where we are right now. And so according to some of the people that we would look to, and I use this quote for a number of reasons, but Ken Fisher says, you've seen the headlines. China meltdown, Greece collapsing the Eurozone, the risk of basking UK businesses, the US debt bomb, Europe's quantitative easing is going to fail, and that the stocks are overvalued. Widely known fears are not risks, they're gifts. And many believe that this environment that we're in, this stagnation, where you have a period of low interest rates, low growth, and a moderately growing economy is actually the sweet spot for the stock market. So when I talk about all the bad news in the economy and people struggling and their incomes not being so great, many people believe that that's just the food for thought for a good stock market, and that when we have all of these fears and all of these headlines and that Greece is going to exit the euro and China's going to blow up, that is what keeps this bull market going. Any good market will climb a wall of worry. When I come here and I have no problems to talk to you about, that's when we'll all need to start worrying about the stock market. Because if we're all blissful and in that euphoria, that's when you're likely to have a problem. But this period of low interest rates and low growth can actually be very good. Bill Gross, he disagrees. And I highlight this for a couple of reasons. Bill Gross is much more of a bond guy than he is a stock guy, but he's widely regarded for his forecasts and what he sees in the future. And he cites a couple of other important people, George Soros, Ray Dalio, and others like him who say that the 35-year super cycle is coming to an end. Well, I would say if you're looking at the bond market only, you would have to agree. We've been in a 30-year bull market in bonds simply because interest rates have been declining for that entire period. I know we've talked to you, go back to the 1970s and 16% mortgage rates, and here we are today, 3% mortgage rates. That is a great environment for the bond market, so when things turn, it's going to be an uphill battle. But what he says at the bottom is most important to me. It says they don't necessarily counsel heading for the hills or liquidating assets for cash. It's just a world of lower returns. And as the cost of capital increases and interest rates go higher and mortgage rates go up and all of those things, they will happen, it doesn't mean that the world will come to an end and that every piece of progress that we've made in the last 5 or 6 years in the markets will come to an end overnight. It just simply means that the world of high returns may be diminishing and returns will be a little bit more difficult to get. The Fed rate hike, and there's so much concern over what's going to happen when. I've been doing this for 30 years, so I've been through a number of tightening cycles. And there's probably that more fear of anticipation than what actually happens. But BlackRock did a study, and they went back all the way to the 1970s, and they looked at every tightening cycle that we've been through. And they found a common trend in each one. That in the first 3 months, from the point of time that the Fed begins to raise interest rates, the stock market goes down. It goes down on average, that far right bar there, goes down on average 4%. That's not fun, but that's not a disaster, right? But 6 months later and 12 months later, the markets are higher. And I'll tell you this, the Fed is going to raise interest rates, and I have no idea whether it's coming in September or December. I'll tell you my opinion is the Fed should start raising interest rates right now. We need to get it over with. She's told us that she should do it, that it should because of the lines that she's drawn in the sand. But here's what I would anticipate. When the Fed raises interest rates, you've got two camps of investors out there. Those who are going to say it's way too soon, we need to keep interest rates at zero essentially forever. And they're going to start selling everything because rates have gone up. And then there's going to be the camp that say, thank God the Fed finally raised interest rates, but oh my God, this is going to get ugly, and they're going to sell stocks. So no matter what we do at this point, the country, or I should say investors, are extremely divided on living up to the reality that we're going to get there, and it's going to continue to cause that choppiness in the market. But again, the longer term of this, interest rates go up because the economy's getting good. So when we start raising interest rates, you get that knee-jerk reaction. It doesn't mean that it's a long-term negative. Many worry that because this cycle starts at such a low place, there's 0 to a quarter and then that quarter to 50, that is very different than tightening from where we were, and that since we've had Fed intervention for so long, we're in uncharted territory, okay? That's where we are. We've never had to do this before. So none of us really know exactly what to expect, so I bring you back to my first chart of the Dow, up and down, up and down. My reference to interest rates, up and down, up and down. Nobody knows exactly what to expect. Forecasting isn't easy. 2012, they took a look at all the economists and what their projections were. Only 46% of the time they were right. So you can flip a coin, and so we can talk about all these different projections of what people see. it is very difficult to get it right. But what we do know is that as we move through the back half of this year, and an awful lot is going to happen, there will be opportunities in this market. And it's going to be our job to continue to figure out what those opportunities are. The reality is, this market is digesting a lot of information. Declining global growth, a transition from years' worth of Federal Reserve support to now the Federal Reserve taking that away. The reality that in other parts of the world, they're just beginning to stimulate these markets. What will the impact ultimately be? We have had 6 years of solid gains. The fact that we've gone nowhere for the last 7 months is a completely normal and healthy transition for an economy and in a market that's going through a complete reversal. And the fact that that first chart, so the interest-sensitive stocks had sold off, that makes sense. What has been working with declining rates, lower inflation to a rising rate environment, things will be a little bit different, but that's okay. One of the trends that we see right now that everybody's banking an awful lot on are the millennials. We've got these millions of kids who came out of college heavily in debt and no jobs. And suddenly we're starting to see it in the numbers. They're getting jobs, the labor market's getting better. They're getting out of their parents' basements, they're getting into apartments, rental rates are absurd around this country. They're buying houses, they need cars, they need stuff. There's a lot of hope that some of this transition is going to be very helpful to the economy as we move forward. For those of you who are parents and grandparents, in summary, I'll say we got to look forward to the good things in this country and look forward to a period of time in which the millennials will become our thought leaders and our decision makers. Today, they currently make up only about 30% of the workforce. It's estimated that they will represent 50% of the workforce by 2020 as all the baby boomers begin to retire and go on to their next phase of life, that the millennials will begin to take that seat. So I thought I'd leave you with that note and this quick video.
I'm a millennial.
I'm a millennial.
I'm a millennial.
I'm a millennial, and I'm sorry.
And I'm sorry.
We suck, and we know it.
We're self-centered. We're entitled. We're narcissistic, lazy, and immature.
And we're super sorry about that.
We're the worst. If only we could be more like our parents.
Yeah, the baby boomers. You guys were great.
He gave us great music.
60s counterculture.
Psychedelic drugs.
A lot of great movies, too.
Jurassic Park was awesome. Good job with that one.
We don't know what happened. You raised us to believe that we were special.
So special that we didn't even have to do anything to earn it.
I got this trophy for existing in soccer.
That's pretty special.
No idea what went wrong.
You tried your best. You insisted we all go to college, and now we're the most educated generation in American history.
Sure, college costs 600% more than it did when you went, and yes, we averaged like $30,000 in student loan debt.
But here we go again, making excuses. We're so lazy.
Instead of living in our parents' basements and waiting tables, we should just go and get real jobs, like you did.
I mean, not a job in manufacturing since those all got outsourced in the 90s.
Man, the 90s were great. Do you guys remember Full House? It's a good show.
We graduated into a recession, and 90% of the jobs created since 2009 are part-time. But let's be honest, we just don't like hard work.
Hey, what was the deal with that recession anyway?
I think it had something to do with the housing bubble that started in the 90s. I don't know, I was still pretty young back then.
Oh, and we're really sorry about messing up those 2 wars you guys started. Sorry so many of our friends died.
We just can't do anything right.
We're really sorry we suck so much.
I mean, it's not like we jacked up college tuition prices or
Destroyed the manufacturing industry.
Started 2 quagmire wars.
gutted the unions.
Destroyed the global economy.
And left our offspring with an environmentally devastated planet stripped of its natural resources.
Man, it'd be crazy if there was a generation that recklessly awful, huh?
but we do text too much. Ugh.
I know, right?
So on behalf of all the millennials, we'd like to apologize for being so terrible. From now on, we're going to be just like the baby boomers.
Because you guys, you nailed it.
Drinking a craft beer, hashtag hops.
It's kombucha. I brew my own. It's with yerba mate and palm sugar.
Oh my God, Julia! Whose turn was it to get sriracha this week? Fine, I'll get it.
Siri, how to fix a bicycle. Call my dad.
Feels so much better now, right? Well, thank you all so much for coming tonight. I hope you enjoyed this evening's presentation. As usual, we thank you for taking the time to come tonight. If any of you have somebody you'd like to recommend to the firm, see one of the girls on the way out. We do have some pamphlets to provide you. But again, most importantly, thank all of you so much for being here and for being our clients. Thank you very much.